After studying this module, you shall be able to know about the concept of bill of exchange and bills financing, learn about types of bill finance, learn about project finance, evaluate the role of debt and equity holders in financing a project, analyze the need of project finance. Funds requirement of commerce and industry are mainly fulfilled by banks through cash credit, corporate deposits and overdrafts, and purchase/discounting of commercial bills. Bill finance is also provided by banks. Bills of exchange are used in the course of normal trade and commercial activities are called commercial bills. Bill financing is an ideal mode of short-term financing available to business concerns. It imparts flexibility to the money market besides providing liquidity within banking system. It also contributes towards the effectiveness of the monetary policy of the central bank of a country. According to Indian Negotiable Instrument Act 1881, bills of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of that instrument. Let's first start with bill finance. The bill of exchange is a document in writing and an unconditional order by one person who is known as drawer to another who is known as drawee to pay a specified sum either immediately or on a predetermined fixed date. It is also called a term bill for payment of goods and or services purchased or received. The drawee accepts the bill by signing it. It essentially is a trade-related instrument that finances a genuine trade transaction. As per 1930 convention, which aims at providing a uniform law for bills of exchange and promissory notes, a bill of exchange contains 1. The term bill of exchange written in the body of the instrument and expressed in the language used in drawing up that instrument. 2. It is an unconditional order directing drawee to pay a determinate sum of money. 3. The name of the drawee, that is person who is supposed to pay the money, a statement specifying the time of payment. 4. A statement of the place where payment is to be made. 5. The name of the person to whose or to whom order payment is to be made. 6. A statement of the date and of the place where the bill is issued. The signature of the person who issues the bill, that is drawer. A bill of exchange is the most often used form of payment in local and international trade and has a long history as long as that of writing. A method of financing of trade activities through bill of exchange is known as bill financing. It is also called bill discounting. Bills financing involves parties such as the drawer, that is seller, the drawee, that is the buyer, and the financier, that is the banker. In other words, bill finance involves provision of medium and short-term finance for the benefit of trade and manufacturing sector. Bills finance seeks to provide finance to manufacturers of indigenous machinery, capital equipment, components, sub-assemblies, etc., based on compliance to the various eligibility criteria, norms, etc., as applicable to the respective schemes. It is more advantageous than cash credit or overdraft system as the underlying transaction is known. Bill of exchange is transferable and can be rediscounted to improve the bank's liquidity. The mechanics of bill financing is depicted in figure which says a buyer has two options for making payment. He may immediately pay for goods purchased or postpone the payment to some time in the future. If the latter option is chosen, the seller is said to have sold goods on credit. The seller of goods on credit, in order to have evidence of the sale transaction and in order to obtain due payment after a specified future date, draws up a bill of exchange. The seller who makes a bill of exchange is called the drawer, and the buyer in whose name the bill is drawn is called the drawee. The bill is then sent to the buyer for acceptance. The acknowledgement of the debt due from the buyer is called acceptance of the bill. The acceptor could be the buyer or any third party willing to take on the credit risk of the buyer. Types of bill finance. Discussing about the bills of finance, we can say banks generally offer three types of bill finance. Number one, bill purchase. Banks negotiate clean or documentary bills payable on demand. The face value is paid to the holder immediately. After the purchase of the bill, the bank becomes the holder of the bill and acquires all the rights of its ownership. 2 is the bill discount. It is payable after a predeterminate period within bracket usance bills. The bank pays the face value of the bill after deducting the discount. After discounting the bill, the bank becomes the holder and acquires all the rights. 3. Advance against bills for collection. The bank's advance against the bills that are in course for collection. The banks advance an amount after deducting a prescribed margin to the customer. Then the bills are sent for collection. The bank is considered the holder of the bill in due course of bills. Discounting a bill within bracket commercial bill discounting oblique financing. When a seller or maker of the bill is in need of cash to meet operating expenses and cannot wait till the maturity date, the bills which are in custody with the banker is discounted to obtain a loan. Such a loan will be liquidated on or before maturity of the bills through a payment made by the drawee. In developed money markets, there are acceptance houses which, after due diligence, give acceptance for a fee, thereby imparting added security to such bills. When the drawer or seller of the bill deposits commercial bills, in short CBs, and contains financial accommodation from a bank or financial institution, it is known as bill discounting. Instead of discounting the bill immediately, the seller has an option to wait till the maturity date. Commercially, the option of discounting will be advantageous because the seller obtains ready cash, which can be used for meeting immediate business requirements. However, in the process, the seller may lose a little by way of discount charged by the discounting banker. Following are some of the provisions related to the bill of exchange in Negotiable Instrument Act. Number 1. Holder. As per Section 8, the holder is entitled in his own name to purchase the bill and recover the bill amount. Number 2. Holder in due course. As per section 9, holder in due course is who for a consideration becomes the possessor of the bill. He is the person to whom the bill is transferred. Number 3. Payment in due course. As per section 10, is the payment made to the holder in good faith and without negligence as per the apparent tenor of the bill of exchange. Number 4. Negotiation. As per section 14, the transfer of a bill to a person for a consideration such that the person is entitled to claim the bill amount. Number 5. Endorsement. As per section 15, is the signing of the bill of exchange by its holder for the purpose of transferring it. The rest are: number 6. Liability of the drawer. As per section 30, the drawer of the bill of exchange has to compensate the holder if the drawee dishonors the bill. However, the notice of the dishonor should be provided to the drawer. Number 7. Liability of the acceptor. As per section 32, the acceptor of the bill has to pay the amount of the bill on the maturity and as per the apparent tenor of the acceptance. Number 8. Liability of the endorser. As per section 35, a person who endorses and delivers a negotiable instrument without any contract to the contrary is liable to every holder in case of dishonor. Sometimes the endorser's liability is expressly excluded. Number 9. Specified interest rate. As per section 79, if specified interest must be calculated at the specified rate. Number 10. Unspecified interest rate. As per section 80, if not specified, interest on the instrument must be calculated at 18% per annum. We can look at financing into two categories. 1. Corporate finance. Number 2. Project finance. Corporate finance is essentially how do companies make their financial management decisions. There are broadly two sources of funds, namely equity and debt. Equity is capital contribution by the owner and debt is a capital contribution by the lenders. So in most circumstances, the owners might not be able to contribute the entire amount of that the investment needed by the firm. And therefore, they will invest part of their contribution as sponsors' capital and then remaining that borrowed will be the debt capital. So consequently, investors in a company can be of two types. First is the shareholders and second is the debt holders. The investors who invested in the equity are called as shareholders and the investors who provide debt, they are called as debt holders. It is very important in the world of finance to really look at how the different investors get returns. For example, an investor would expect a return for investing in the project and owner will also expect the return on the capital that is actually invested in the project. So the return from the investment has an important role for both type of investors. So if we look at debt holders will actually get interest on their investment. So in that sense, the interest that debt holders get is the return on their investment and at the end of the long term, the company would also repay the principal so that there is repatriation of their original invested capital. Also, the shareholders only get the residual payments after all the other obligations of the firm has been met. And due to some unpredicted circumstances, if the firm gets into bankruptcy, then the shareholders are eligible only for residual payments after the lenders and other investors in the company have been paid. So this is largely what is called corporate finance. In corporate finance, just because a particular project has failed, the investor in that project need not necessarily suffer. If there is a failure of a particular project, the cash flows from the other projects or other profitable projects of the company are expected to be used to service the investors of the company. Let a firm has a project 1, which is being financed by a certain amount of debt and equity. Further assuming there is another project 2, which company has found more profitable than project 1, and raise money for project 2 from same or different stakeholders who have invested in project 1. So in essence, both the projects are separate, and that means they are not part of same corporate structure. So an investor who is actually invested in project 1 is looking at only the cash flows from project 1 to service their return requirements. An investor who has invested in project 2 is looking at the cash flows from project 2 to service their return requirements. Suppose project 2 fails, then the investors who have invested in project 2 will not get the return or recover their amount that they have invested in this project, simply because of the fact that project 2 is actually incorporated as a separate entity, and lenders or investors in the project will look at only the cash flows from the project 2. Therefore, project financing is defined as financing of individual projects, and since the individual projects by themselves are individual companies, then the investors in this project will have recourse only to the cash flows of the project and not cash flows to the corporate structure or to the cash flows of other projects under the same corporation. In other words, project financing is referred to the long-term financing of infrastructure and industrial projects that are based upon the projected cash flows of that project rather than the balance sheets of its sponsors. This financing is typically secured by all of the project assets, including the revenue producing contracts. The physical assets of project company are likely to be worth much less than the debt of the company if they are sold off after a default of the financing. And in projects involving public infrastructure, they cannot be sold anyway. So the main security for lenders is the contracts of project company, licenses or other rights, which are the source of its cash flows. Therefore, lenders carry out a detailed analysis of the risk associated with the project and how these are allocated between the various parties. Some of the features of project finance. Number 1, each and every project is established as a separate company. That means it has its own financial statements, own set of shares being issued, own sets of lenders. Number 2, major portion of the project equity is provided by sponsor. Equity investors are divided into two types of active, that means actually promoting the project, that is sponsors, or passive equity investors. Project company operates with a high ratio of debt equity. In a project finance company, substantial amount of capital is by way of debt rather than equity investment. Important thing to note is that rarely a company uses all debt or all equity to finance its projects. There are different parties to project finance depending on the type and scale of a project. Most of them are number 1 contractor, number 2 supplier, number 3 sponsor, number 4 lender, number 5 customers, number 6 government, number 7 financial advisors, number 8 technical advisors. Moving on to the needs of project financing. A project may be financed by a company as an addition to its existing business rather than on a standalone project finance basis. In this case, the company uses its available cash and credit lines to pay for the project, and if necessary, raise new credit lines and new equity capital to do so. That is, it makes use of corporate finance, provided it can be supported by the balance sheet of the company, its earning records. A corporate loan that is taken to finance a project is normally relatively simple, quick, and cheap to arrange. Unlike a corporate borrower, a project company has no business record that can help it to serve as the basis for making lending decisions, unless a project finance loan is being refinanced. Lenders have to be confident that they will be repaid, especially taking account of additional risk from the high level of debt inherent in a project finance transaction. There are a variety of reasons why investors use project finance. Number 1, high leverage. One of the major reasons for using project finance is that investments in ventures such as power generation or road building have to be long term but do not offer an inherently high return. High leverage improves the return for an investor. Number 2, lower cost. If the project company is selling a commodity such as electricity into a market, the lower the financing cost, the more competitive its pricing can be. And hence, the higher leverage may be beneficial if the weighted cost of an investor's capital, that is equity and debt on its own balance sheet, is higher. Number 3, borrowing capacity. Project finance increases the debt, that is liability of the firm, that it can borrow against a project. Moreover, non-recourse finance raised by the project company is not normally counted against corporate credit lines. It may thus increase an investor's overall borrowing capacity and hence the ability to undertake several major projects simultaneously. Number 4, risk limitation. An investor in a project raising funds through project finance does not normally guarantee the repayment of the debt. The risk is therefore limited to the amount of the equity investment. If the project goes well, the investor will earn a good return on the investment. Otherwise, the investor can simply walk away so that it can limit the loss to the amount of the equity investment. Next is risk. Number 5, spreading oblique joint ventures. Sometimes an investor is not able to undertake a particular project, so others may be brought in to share the risk in a joint venture. This both enables the risk to be distributed among investors and limits the amount of risk undertaken by each investor because of the non-recourse nature of the debt financing of the project company. Number 6, developer leverage. Sometimes some projects are put together by a developer with an idea but little money, who then has to find investors. A project finance structure which requires less equity makes it easier for the weaker developer to maintain an equal partnership because If the absolute level of equity in the project is low, the required investment from the weaker partner is also low. Number 7, enhance credit. Credit rating of company is less likely to fall if its risk on project investments are limited through a project finance structure. Number 8, long-term finance. Project finance loans typically have a longer term than corporate finance. Long-term financing is necessary if the assets financed normally includes a higher capital cost that cannot be recovered over a short period of time, without pushing up the cost that must be charged for the end product of project. So loans for power projects may run for nearly 20 to 25 years, and for infrastructure projects even longer. The most widely used source of temporary working capital includes commercial banks, apart from the other sources, for example, trade credit, installment credit, customers' advances, and indigenous bankers. The sources from which the industrial concerns in India obtain financial resources to meet their intermediate and long-term financial requirements are share capital, bonds and debentures, commercial banks, public deposits, and term financing institutions, including development banks. The development banks as a source of finance differ from other sources in the sense that they provide financial support in multiple forms under numerous schemes instituted by them to suit the industrial enterprises belonging to different industries of national importance situated in different regions of the country. They provide financial assistance to the industrial concerns not only in form of foreign currency loans, they are a channel through which foreign capital and skills flow into the national economy and reach those enterprises which are too small to attract foreign capital and technology themselves. Earlier, we had few specialized development banks, for example IDBI, ICICI, etc. But now, the role of development banks has been merged with the existing banks and are now known as universal banks. Let's summarize the above discussion. Bill financing is a popular mode of trade financing that helps traders to obtain financial accommodation from the banks. Bill financing acts as a glucose to the firms who are in need of financial accommodation for their bill of exchange. Financial intermediaries act as a hospital for the firms and take care of fund requirement. Project finance refers to the technique of financing projects which are dependent on projected cash flow as defined by the contractual relationship within each project. The project usually included major infrastructure investment with a long construction period and long operating life. So the financing must also be for a long term. Decision pertaining to pay interest and fees and to repay the debt depends on the future cash flow projected to be generated by the project. Therefore, the project must be legally and economically self-contained.